Hello and welcome into the Cato Institute in Washington, D.C. My name is Ryan Tracy. I'm a journalist with Capital Account and very happy to have you all here with us for a discussion about financial markets and financial regulation with two scholars from the Institute. We have Norbert Michel, who's Vice President and Director of the Center for Monetary and Financial Alternatives at the Cato Institute. Welcome.
Thank you. Thanks, Ryan. Thanks for doing it.
And Jennifer Schulp is Director of Financial Regulation Studies at that center.
Thanks.
So again, so happy to be here because we've got a broad audience today. You know, we're broadcasting live on X, and there may be people who are coming to us with wondering who these people are. I wanted to first take a minute and talk about what who each of us is and what we do, and then we'll jump right into this very relevant policy conversation right now. So. As I mentioned, I write for Capital Account. It's a publication that that focuses on financial regulation and the intersection between Wall Street and Washington. And Norbert, maybe you could say a bit about your center and what you do.
Sure, thanks. So our center here at Cato focuses on, because we're Cato, focuses on free market policies, policies that promote free markets and individual liberty, and we focus on those policies that are specifically in financial markets and monetary policy. So that's what we do.
And Jennifer?
Yeah, and I'm a part of that center as well. My focus is on securities and capital markets and other types of financial regulation.
Yeah, and you know, Cato's a think tank, right? So this is an idea factory, and we're going to talk a lot about ideas today. And it's a great time to be doing that. You know, both of you have a new book out called Financing Opportunity, and we're going to get to that book in a minute. But you know, this is such a fascinating time in Washington, D.C. because we've got a change in administration, and that's going to bring a whole lot of change on these issues of how the government interacts with financial markets. So I wanted to start there before we talk about the book. And you know, there's an old saying, as you all know, personnel is policy, right? What this next administration does is going to be driven by the people that have been appointed to it. So Norbert, what's your reaction to the people that Trump has appointed so far that are going to be in charge of this issue of how the government interacts with financial markets? We've got Scott Bessent, who's the nominee for Treasury Secretary. There also was Paul Atkins yesterday nominated to lead the SEC. Bessent's a former hedge fund manager. Atkins is a former SEC commissioner who's been in Washington for a while. Yeah. What do you make of all that?
Well, I know Paul a little bit, and Jen does as well, whereas we don't really know Scott. I like having somebody from the outside come in, sort of a clean slate. You know, they're not already sort of worried about all the things that happen in Washington the Washington way. They might have their own agenda, which I don't really know, but I'm okay with that, but given that it's just sort of different, right? So I'm okay with that. I mean, I don't, like I said, I don't have any reason to think that it would be bad or good, but just the fact that he's an outsider, I like.
Yeah, and I would say on Paul Atkins, actually the fact that he has been at the SEC before and knows exactly how it works is, I think, a major plus. So instead of an outsider in Paul Atkins, you have someone who is deeply steeped in the securities laws, has spent time at the agency, so understands how it works, and the task in front of him is a pretty tough one. Gensler has done a lot in the agency over the past 4 years, a lot of which needs to be undone or walked back. Putting an outsider to helm that agency at this point puts them at a disadvantage because they won't understand how the agency works and how to get things done. Paul won't have that problem. And he spent a lot of time over the past decades thinking about a reform agenda for the SEC. I think he's a great pick to lead the agency, and that agency is going to need a lot of leading as we move into the new administration.
And Treasury is so much broader, you know, where Paul, like there's a very, very specific agenda and set of tasks that are clear, whereas Treasury, you know, that's just sort of the leader for the administration on a broad set of issues. So I think that's why those two things, and possibly having those two things together is good. And could be.
I'll say, and personnel is policy. We are missing a lot of personnel still in terms of who's going to be making financial markets decisions. We've heard nothing about the banking regulators, who's going to be leading those. We haven't heard who's going to be leading the CFTC or the CFPB. So there's a lot to be built out still in terms of, I think, what the Trump administration vision is going to be for financial markets policy.
But what can we infer from those picks? I mean, is it fair to say they signal change from the last 4 years?
Oh, absolutely.
And talk about that. Like, what kind of change in approach at a high level do you see coming when you look at those folks? Yeah, go ahead.
Yeah, I would say for the SEC, I think it's a very clear signal of change from the past 4 years, the Gary Gensler era. That's not a surprise. Trump campaigned on firing Gary Gensler on day one and was very excited to look for change at the SEC. Atkins is well positioned to do just that. But that's not a surprise at all. We knew that was coming. I think it's an interesting question as to what it signals different from Trump's first administration, where his pick was Jay Clayton, who didn't come in with a reform agenda. Jay Clayton came in with a much more traditional Republican stance of making tweaks and kind of keeping the trains running at the agency. Paul's going to, I think, responsibly tackle these questions, but Paul is a reformer. And I think is going to have a long list of tasks, both that he wanted to do before Gary Gensler became chair, and things that he wants to undo that Gary Gensler has done over the past 4 years.
And although we might not have a lot of detail yet, if we go by the first Trump administration, they're not. I mean, if we take sort of like them at their word, then we're going to have less regulation, right? It's going to be less of the same sorts of things that we've been having. Can't really name all these people yet, obviously, because they're not there. So we'll see. But I mean, they did do a lot of good regulatory agency level stuff in terms of reducing some of the bad stuff. So I don't know why we would expect anything radically different than that. And that's from our view, that's a good thing.
And let me ask you about two issues that I think, again, if we've got some people coming to us on X and my X algorithm is any indication, these are issues that there's a fair number of people on there who care about. One is obviously crypto. And you mentioned Trump talked about firing Gensler on day one. That was at a Bitcoin conference, I think, or a crypto conference. And so talk about what change you expect and even what change you think should happen when it comes to the approach to crypto policy. Obviously there will be some, I'll note the price of Bitcoin hit $100,000 for the first time yesterday, the day before we're having this conversation. So, you got to think that's at least in part about excitement about a new approach in the U.S., not only to crypto, but to other new technologies. So, talk about what you hope and expect on that front.
Yeah, I think the first expectation is that kind of this SEC campaign against crypto is going to end. And I think there's no question that that is going to happen. The enforcement first, make rules never approach that the Gary Gensler SEC time had been pushing will be over on day one. We don't even need to wait for Paul Atkins to be confirmed for that to happen. Whoever's going to be the acting SEC chair, I think, will be of the same mind. They'll start reviewing enforcement actions that have been filed. They'll start taking a look at investigations that are in the works to determine whether or not those should continue. And I would expect a large majority of those will find their way to the trash bin in one way or another. Mm-hmm. Making that happen can be a complicated process, so I don't think everyone's going to get closing letters on January 21st. There'll be some time as that works out, but that's going to be, I think, one of the first steps. But there's also going to be a lot of focus at the SEC in terms of creating a regulatory regime that provides regulatory clarity for crypto. And I say I'm talking about the SEC, but it's not just the SEC that's going to be involved in this process. The CFTC, the banking regulators, and others, I think are all going to be taking a hard look at the regulatory landscape as it stands now and how that can be made more clear and welcoming to crypto technology and other financial innovation. That's a much longer process. It's a much more complicated process, particularly because the last 4 years have put the brakes on the agencies really being able to dig in and start that process. Everyone's starting a little bit behind the ball, and we'll see how long it takes to really get that spun up.
And just having that lack of a hostile environment, I think, is huge. So I think everybody's kind of hopeful. And again, it's partly based on the first Trump administration. You're not going to have that extreme adversarial relationship on many of those areas.
Mm-hmm.
So I mean, I think that's a reasonable expectation at the very least.
And in the past week or two, some of the discussion around crypto from people like Elon Musk, Mark Andreessen, the prominent venture capitalist who went on Joe Rogan's podcast last week talking about this, is this issue of debanking. And as you know, but just a little bit of history for the viewers who may not, this is not something that's specific to crypto, right? This has been an issue in Washington for 10 or 15 years now. And it basically is this idea that, banks are cutting off customers who they believe regulators may not want them to have a relationship with. And there are certainly examples of regulators being very explicit about that. There are also examples where it's a little bit unclear what happened and maybe the customer didn't get a very clear explanation. And, perhaps the bank is just being risk averse. They weren't necessarily told to do it. Again, to be clear, there are instances when they were told to do it. So this discussion relates to crypto because in the past week or so, a number of crypto founders, following Andreessen's comments, have come out and said, hey, I was debanked, right? The CEO of Ripple, Brad Garlinghouse. You had a representative of Facebook's old Libra project coming out and saying the Fed leaned on their banks to abandon it, and on and on. And there's this optimism that, hey, this is going to be approached differently. So, Norbert, I know your expertise is more in banking, but what do you make of sort of what could, first of all, like how big a deal is this issue, and what kind of change? How do you make change? How do you address it?
Yeah, I mean, it's a huge deal. You've had Operation Choke Point. Now you have the crypto is sort of like under Operation Choke Point 2, and you have literal instances of regulators saying, well, we need to choke them off from access to the banking system, and that kind of keeps all those companies on the fringe. And that's based on really nothing other than somebody's opinion. So I mean, that's a huge problem. A lot of the conversation, especially over the weekend, was about how the Bank Secrecy Act and any money laundering rules are kind of what drives this, and that's true to some extent, but it's actually much bigger than that. Regulators have a lot of discretion. They can use something called reputational risk, and then they have a lot of discretion on what they consider to be a threat to safety and soundness. So they can kind of just go in and say, well, if you guys are doing business with those crypto customers, that's a high risk. Those are high risk customers, or something along those lines. And if you're a bank, you're going to tell the FDIC, I don't care if you think that I'm too risky. No, that's not at all what's going to happen, right?
Right, you're a bank, you're heavily regulated.
Yeah.
And this is your, a person that could even, in theory, shut you down or sanction you.
Revoke your insurance, your Camels rating, and
how
everything.
How does the message get delivered? Give people an idea of what that dynamic is like.
Well, I mean, so some of this, and this is documented, so this isn't me just theorizing, but also a lot of this has been the examiners going in and saying, kind of what I just said, which is that if you're doing business with, for example, payday lenders or small dollar lenders, that's a problem because your reputation is going to suffer, or that's a problem because those are high risk customers. Even if you're dealing with a third party that deals with them, we consider that to be high risk. And they don't have to say, stop banking with them. That's all they have to say. So if you're the bank, you're going to have, obviously you have the deposit insurance held over your head, but you also have to worry about what your ratings are, your Camels ratings. Because if you want to operate if you want to do a merger and acquisition, if you want to expand, if you want to open a new branch, your rating can't be bad. So you really have no choice. And then the sort of insidious part of that is you have no recourse. You can't go and complain to anybody or go to court or do anything. So, and that's why I think that this is a problem that needs some sort of a legislative solution. Why? But that's a little tricky. Well, because a lot of the stuff that you see going on, like an examiner informally saying something, or even an MRA, memorandum.
A matter requiring attention.
Matter
yeah.
requiring attention.
The way the regulator communicates a concern that they have to the
Exactly,
bank formally.
exactly. So before there's even an informal enforcement or a formal enforcement act, those are the tools that are used, and there's nothing to go to court over.
Yeah.
Like say, well, the regulator doesn't like me. Like you can't, you're not, like a judge isn't going to listen to that. That's not an actionable offense. So there's nothing to say that anybody's violated any particular law. So I think that some of that discretion needs to be pared back, and you've got to take a really hard look at, the right way of doing that. But that's, I think, going to have to happen.
And I just add to that it's been a recurrent problem.
Yeah.
Norbert talked about Operation Choke Point 1.0, which was an Obama-era issue. We're talking about Choke Point 2.0, which is a Biden-era issue. But you can see easily how this exercise of discretion isn't limited to necessarily problems that the Democrats want to solve or problems that the Republicans want to solve. You could just as easily see a Republican administration operating a Choke Point 3.0 against disfavored industries from a Republican side. So a legislative solution that cuts back on some of this discretion ties the hands of both parties, which is a better outcome for people who operate in legal industries that might draw political scrutiny depending on who's in charge.
Mm-hmm. Well, and it goes to this. Well, actually, before I broaden out, just to your point, Jennifer, there are Democrats who have been concerned that Muslim charities have lost their bank account because of a federal regulator saying, hey, we're concerned that this may not really be a charity, it may be some conduit to a terrorist organization or something. And so debanking is very much a bipartisan concern. And it really goes to this issue of, which is what your book is about. Let's go to the book, which is, have we as a country gotten this balance right in terms of the power that we've given these financial regulatory agencies? So remind me of the book's title. Let's get the plug right.
Financing Opportunity.
Financing Opportunity.
It's the short title.
Tell me about why you decided to write it.
Well, one of the reasons is the answer to that question, which is we think the balance is completely out of whack. There's a really big misperception that financial markets were deregulated leading into the crisis, and a broader perception that they're not really very, very well regulated or very heavily regulated. And that's just not true. Neither of those things is true. So that's one of the reasons that we wrote the book. And then the other reason is because financial markets always get flack for everything, right? Something goes wrong and it's the evil financial markets, whether it's the evil big banks or the evil Wall Street guys. And the funny thing is that sort of angst towards financial markets predates the United States. I mean, this has just been going on forever, really, literally biblical times. So we wanted to get that out and point out that in the modern times, even starting with the Great Depression, a lot of that stuff is really just political rhetoric. To say that excessive trading or excessive speculation caused the Great Depression. John Maynard Keynes, one of the most famous economists ever, said that. It's strictly an opinion. There's literally no evidence. People have looked at this too. Like, there's just no evidence that that's what caused anything. And it happened again in 2008. All the wild speculative activity. Well, nobody thought it was too speculative, until it was in hindsight. So it's really not an explanation at all. And what doesn't get told is all the good stuff. So we wanted to have a book that said, look, yeah, there's a lot of risky stuff and a lot of stuff that happens, but that's what's supposed to go on there. And there's a lot of benefits, you know. You don't get the enormous prosperity that you have in the United States without those financial markets. And people forget that too readily. So that's the longish version of why we wrote the book.
Yeah, risk and speculation shouldn't be dirty words. We understand why they get that rap, but risk is the price that you pay for benefit as well. And it's important to really examine the benefit side of the equation in terms of what financial markets do. Another reason that we put the book out there, and I think we spend a lot of time in the book, is talking about the regulatory system as it exists now and educating people about what certain financial instruments are and what they do. So instead of just hearing a derivative, you understand what a derivative is used for and why the derivative itself is not inherently the bad guy thing, or what a stock does, what an ETF does. What are those things that you see on CNBC but might not pay much attention to until there's a dip in the market, and then it's easy to just lay blame. So we really wanted to have kind of an educational enterprise here too, to bring people along on this journey about the history, but also about the mechanics of what our regulatory system looks like today and why you should care.
And what I found so interesting about the premise is, you know, certainly people associate with the left and progressives this idea, you know, the Occupy Wall Street movement and big banks are bad, but it's not just the leftism. I mean, you talk about it in your book about comments by Tucker Carlson and Marco Rubio, who's, you know, Republican senator now, perhaps going to be part of the Trump administration. Talk about that aspect of it too. What do you hear from conservatives sometimes on this?
Yeah, you want me to do a little?
Yeah, go for it.
There's been a lot of this lately, last couple of years, and Tucker Carlson's a great example. You know, Wall Street is wasteful. They're just trading paper. You know, they're not doing anything productive.
Just moving money around.
They're just moving money around, which is also actually borrowed from, you know, a very long time ago. It's in the Hamilton play. But
you went back to Babylon in the book. Right?
yes.
Yes.
Yeah. We don't have to go that far. Yeah. But the Republicans lately, you know, they want, it's sort of this populist Republican movement to say, well, we need to revive manufacturing, right? Well, Wall Street, that's not what supports that. Wall Street's just moving paper around. What we need to do is invest in the real economy, in real things, in making things. And, you know, that's also not new. But regardless, what they want to then do is empower bureaucrats to stop people from doing even more. And from our view, and I think we make the case pretty well in the book, like that's already what happens. You don't need to do more of that. And there's really no objective way to go through and say that investment's excessive, that investment's okay. And if you kind of take some of what they want to do to the logical conclusion, all the trades that people generally make in their accounts, their 401k or their E-Trade account, all that stuff, like all secondary market trades, well, none of that directly invests in any real asset. So are we going to outlaw all of that? And if we're not going to outlaw all of that, then who are you going to pick and choose and say, well, you guys can't do that one over there, this one's okay over there? That's a nightmare. That's not the rule of law. You know, you talk about discretion, too much discretion for debanking. Now we're talking, you know, I don't think we've called it de-stock marketing yet, but I mean, but that's what you're talking about, you know, and that's not okay.
And
it's coming from the right.
Yeah, the right and the left.
And the left.
And the left. And the left.
Yes,
Yes.
the left.
And one of the points that you talk about also is this story of deregulation that is really a pretty popular story, and one that you hear a lot from both sides about. You alluded to this earlier, but you know, when we have a event like the Great Depression or the 2008 financial crisis, deregulation gets blamed, and your argument is that you have a problem with that point of view. Why?
Multiple reasons. First of all, if you just look at what happened, and one of the things that we do in here is we've compiled a list of all the people who give examples of things that were supposed to be deregulatory. And if you just look at them very carefully, or even slightly carefully, you'll see that they didn't actually deregulate anything. If you mean by deregulate, nobody cares what you do, nobody's watching what you do, nobody has any rules for what you do, none of that stuff was deregulatory. None of it. The Gramm-Leach-Bliley Act is the big one, right? And people say, oh, well, we got rid of Glass-Steagall. Well, we didn't actually get rid of Glass-Steagall. It's much more subtle change than that. And a lot of the banks were already doing those things anyway, just by force of just economic change that had taken place. And all of their U.S. affiliates, foreign affiliates of all those U.S. banks were already allowed to do that under the law anyway. So it's just not the case that they ended up with less rules, less regulations, and less oversight. And the idea that the bank regulators didn't know any of this stuff was going on, like credit default swaps and mortgage-backed securities, that's ridiculous. A lot of that stuff originated, most of it actually, originated in the banking sector. All of those banks have federal regulators in their banks every single day. The idea that nobody knew about any of this stuff for any reason, much less deregulation, is just completely wrong. And we document that very carefully in the book.
And, all right, I'm going to maybe shift and play a little bit of devil's advocate just to make this a little bit more fun. So, not that it's not fun already. It strikes me that part of what you're saying here is that we as a society should be a little bit less worried about these financial crises. Do you think that's fair, that we sort of are overdoing it in trying to prevent or stop a company from failing? Or
Absolutely.
Yeah. And let me just ask the devil's advocate question. These crises do happen, though, and even though they're low probability, they're high impact when they do, and people do get hurt. So Are you saying we shouldn't care about that? How do you approach this idea of quote-unquote systemic risk?
I'm going to let you take most of this, but I'm
Okay.
going to jump
All right.
in with the first bit and say the system that we have set up, which always has a reaction to a financial crisis, which results in more regulation and more restrictions on the parties involved in these financial transactions, has not done anything to decrease the number of financial crises that we have. In fact, the United States is comparatively crisis-prone compared to other financial markets and other economies. So just to start with, maybe some of what we're doing now is actually a cause of some of the crises as well. So it's not that we shouldn't care about the crises, but we need to zoom back to and think about whether or not the type of regulation that we have is contributing to that.
Well, explain
Yeah.
that, though. How does a regulation contribute to a crisis?
For example, and Norbert talks through this more eloquently than I do, but the 2008 crisis with the buildup of mortgage-backed securities in the financial, or in the banks, one of the reasons that there were so many mortgage-backed securities was because of regulatory changes that had made it more advantageous to hold that type of security by banks. Without that regulation, you would have likely had more diverse holdings from the banks and less of a buildup of one particular type of risk. Those are the types of things that you need to look at and think about when the answer to a crisis is just have everybody do that, because that will fix the problem. Sometimes that creates another problem, and we would have been better off letting more different types of decisions bloom to allow for more resilience.
Yeah, and then you have everybody doing that, and then everybody looks exactly the same. So their portfolio is exactly the same, and that's the opposite of what you want to do. If you want a less fragile system, and you want to have a more diverse system that can actually withstand things, losses from various different things. Instead, every bank balance sheet looks almost the same. So if one asset class goes down, everybody's in trouble. And one of the primary reasons that everybody's bank balance sheet looks the same is because of the regulatory framework. So, I mean, that's a high level discussion of that, but I mean, that's part of the problem. And, you know, like, just to come back to one thing that I said, you know, everybody's got this idea that if we have all these regulations, everybody's going to be safe. Well, I mean, we literally have federal bank examiners going to work at these banks every single day. You know, some of them occupy a floor with hundreds of federal employees. It's never stopped a bank crisis, never. You know, I mean, at the very least, like, let that sink in and just be open to the possibility that maybe what we're doing doesn't really work, you know?
Mm. So if we go down the road of limiting the regulator's discretion, putting more prescriptions on them, you know, one of the examples that you bring up in the book is AIG, which is this huge savings and loan holding company, quote unquote, is the Washington term of art. But basically, you know, they were an insurance company. They had a huge derivatives business, and they almost collapsed during the 2008 crisis, and they were connected to everybody, so it was really a threat to the whole system. And as you point out in the book, AIG was regulated, right? There was an Office of Thrift Supervision, which was overseeing that company. Is the problem that that agency had sort of too much discretion, or just that they did a bad job? I mean, what in other words, what if we just had? Well, and the other thing about supervisors, I guess, to sort of bring in another perspective here is people say supervisors are like spies, right? When they fail, everyone knows. When they succeed, no one knows, because you've prevented a crime. Well, how could you document preventing something bad that happened, right? Yeah. So you know, these are sort of people, you know, trying to do their best. Why is limiting their power the way to go versus, yeah, go ahead.
I don't have any problem with the idea that they all try to do their best.
Yeah.
I mean, I think, but by nature, what happens is you have these large bureaucracies, and, you know, they end up checking boxes. The regulatory system is so complex and so convoluted that there's no other way, you know, to do anything other than that. And what we're doing, you know, in many cases, is taking resources and people, money, hard assets away from actually doing the business that a financial institution should be doing, so that you can check a bunch of boxes. You know, that's not going to help anything. I have argued many times, you could do just as good a job by having a higher capital requirement with less regulation. The capital election that was in the S-2155 bill,
I don't remember the number.
that was in the first Trump administration, during the first, there was a community bank capital election in there. And it was something like a third of all community banks took it. And that was the exact concept. You know, if you have this simple leverage ratio,
a small bank
you don't have to worry about these things over here. You know,
Yeah.
that could be expanded, and I believe it would be much more useful, much more productive.
Well, that brings us to another fascinating aspect of your book and this conversation, which is, so what you're talking about is taking the capital rules that limit how much borrowing a bank can do, how much leverage they can operate with, and making them very simple. Mm-hmm. A lot of banks would oppose that, wouldn't they? And so, you know, one of the things that one of the points you make is that one of the reasons we have these rules is because the industry is somewhat complicit. Tell me about that argument.
That's been the case over the long haul. That has been the case. If you go back to the original Basel implementation, late 80s, banks were definitely for it, because the whole idea is that you would tailor the bank's capital charge to the risk that it was taking. How do you do that? Well, you look at all the assets that the bank has, and you say, well, this one's obviously riskier than this one. So there's less capital on this less risky one, and there's more capital on this more risky one. And that sounds great in theory, but in practice, it's a nightmare. It's a nightmare first because it's a subjective decision in most cases. Obviously, a treasury security is less risky than, you know, some crazy financial arrangement with CDSs on top of CDSs, right? Obviously, there's a different risk assessment there, right? But if the bank simply has one capital charge and then it can take the risk, the risk that it deems prudent, given that it has that capital behind it, and that's what it stands to lose, that's better. I still argue that that's better than having the bank and the regulators get together and go through a list of 100 or 200 or 1,000 different items, trying to minutely change the risk category and risk weight for every single one of those things so that it ends up with a few basis points less on a capital charge.
And in some ways, it is speculative. You're asking a lot
100%,
of the regulators. It's subjective, it's speculative, and when you're funneling behavior, be it banks, securities firms, others, by the regulation, you want them all to act similarly because the regulation has set out these rules. You better be darn sure that you're right in terms of what that regulation is doing. When you're getting down to the minute levels of regulation, the odds that everyone's gotten that right, even
really
assuming
small.
the best of intentions for everyone, are incredibly small. So now you have firms, banks, others that are acting the same way, holding the same types of capital, the same types of instruments, because that's what the rules set up for them to hold. If you weren't right, everyone's going to go down together. And that in and of itself is a problem. More diversity in that system allows for, I would say, individual risk determinations, and the banks can make decisions based on their own determination, but it also allows for more opportunities for different business models and different exposure that can weather different storms.
The system that we have it's definitely harder for a smaller bank to compete, largely with a compliance cost problem, right? So it's not just that it's crazy and convoluted, it's expensive. So, you have examples of people like Jamie Dimon saying, fine, yeah, Dodd-Frank, whatever, I don't care. Like, that's going to help keep some of our competition at bay because the smaller banks can't deal with it as easily as we can deal with it. So just give me the rules and I'm fine. That's not what you want, especially when you go back and think and consider that all this stuff isn't really doing what it's supposed to be accomplishing. So,
Well, and so what rules do you think are appropriate for the financial sector? What kind of regulations would you be able to get behind?
Norbert talked about the simple capital charges. On the security side, the basic disclosure-based regimes that provide information to investors about the material financial state of a company, that are focused on preventing fraud or asymmetric information from the owner of the company to the investor of the company. A lot of the 33 and 34 Acts started with those basic concepts, that we were going to give people the basic disclosures that they needed to have to be able to make a decision about investing in a company. We've moved kind of a long way down the line from that type of simple disclosure that the SEC is now thinking about systemic risk, thinking about maintaining net capital for firms, disclosures about the environment, disclosures about conflict minerals in the Congo. There's a lot more that's currently in the securities system than those basic disclosures. I think those basic disclosures and rooting out fraud are what's necessary to allow our securities markets to function well and function efficiently.
and I think you could have an effective bank regulatory system if you did more of a disclosure and fraud prevention regime than one that tries to micromanage all the decisions of the bank. So the simple capital disclosure is an example. I think you could do a lot more of that. I know that is a radical departure from what we do, and I know that that's a very, very heavy lift. But if you ask me what would be better, I would tell you I think that would be better.
So let's unpack this maybe with a specific example. We've got about 5 minutes left in each of your areas. Because the details of this can get hard. So, Jennifer, you're talking about a disclosure-based regulation for the financial markets, and one thing that people in Congress are talking about and that may actually get taken up in the next Congress is this idea of giving average investors more ability to invest in companies that are not publicly traded, like startup type companies that right now you have to be a quote unquote accredited investor to invest in, which among other things means you have to have a lot of money already. And there's a question there, well, yes, it would be, there's clearly a benefit in giving people another place to put their money where they could invest in the way that a rich person could and get rich themselves or raise capital themselves, more people investing in these companies, but how does disclosure work in that context? Yeah.
I mean, we have the dichotomy in the U.S. of public markets, so the stocks that are trading on the NYSE or NASDAQ, and private markets. These private markets are these investments that typically only accredited investors have access to. And there's no requirement for many of those investments to have any sort of actual disclosure given to investors. That's because investors in those types of investments are presumed to be able to get the information from the company themselves. When you think about the difference between the public and the private markets, if we have folks, if say we got rid of the accredited investor definition entirely, and anyone can invest in public markets or private markets, people still have the option to go to the public markets where they're given more disclosure, and it's there. The private markets remain riskier because there's no requirement of being given that disclosure by the company, so there's choice. But if you have the world that I'm looking at, where the disclosure in the public markets is simplified, is much less expensive to comply with, maybe there's an argument to be made that that type of disclosure isn't as burdensome for smaller companies who are starting out. But the world that we have now, that's not a functional system. You can't expect the restaurateur that operates and really wants to have a few equity investors to make his brand new startup restaurant run, to file an S1 and to do quarterly disclosures on the scale that requires a white shoe law firm to prepare for you.
My little media company, right? Yeah.
Right.
Yeah.
So the short answer to that is, if you remove the ability of, or if you remove the restrictions on private market investing, people still have a choice. And it should be very clear to them that they're not required to be given any disclosures in the private markets, and that is a risk. And they can go to the public markets where the disclosure is required. But we really need a broader rethink of the system that takes away some of that expense to being a public company. And if we did that, I think we'd have more options where companies would want to be public.
And Norbert, a tricky one on the banking side, I think, is deposit insurance. So this has been an issue since last year when there were some large bank failures. The limit's supposed to be $250,000 per account, but when Silicon Valley Bank failed, the government backstopped all the deposits, even above that amount. And so there's been this debate in Washington about how much of these deposits should the government stand behind? Yeah. But part of the reason that exists in the first place is that if it wasn't there and I was going to get a bank account and I had 100 banks to choose from, well, how will I know which bank is safe and which bank isn't to keep my money, right? That's a hard information problem for me as a consumer. Yeah. So,
and we've made it worse because we have the FDIC.
But are you saying we shouldn't have the FDIC? Like how do we skin that cat? How do we solve that consumer problem with that while also addressing your complaint about the regulation?
Sure. Yeah. I mean, there's multiple ways. I think one way is you could lower the limit. The typical deposit's like $5,000, not $250,000. So let's be real about who we're protecting. And then aside from that, financial markets do insurance really well. It doesn't have to be government insurance. And because we have government insurance for deposits, the FDIC, no private insurance company is going to start a deposit insurance company. No private company is going to try to provide that. So if you want to try to get away from that, let's talk about privatizing it and shrinking it.
Well, and proof to that, when the places that are above the insurance limit,
Yeah.
you see private companies operating to assist
To try,
companies that
yeah.
have higher deposit needs in securing insurance or moving money around so that they have those options.
They
So
can cover.
where the government is not involved, there are private market actors who have stepped up in that space. There's no reason that they wouldn't step
Yeah.
up in the retail space.
Well, this is great. Thank you again for inviting me to host this fascinating discussion. Any final thoughts?
Check out our website. Check out our book. We're all about that debate about what the system should look like. So we're excited for the next few years, as always.
Yeah, and I would say Financing Opportunity is the name of the book again. It's available anywhere you can buy books, Amazon, the Cato website, and it's an ebook. You can listen to it, you can read it. We think it's a great primer on these issues that are complicated, but we hope that we did a pretty good job of breaking them down to be understandable and an enjoyable read for people who might not spend all day, every day in this space.
Yeah, it's not a long book.
Very good. Well, thank you both for having me here, and thank you all for joining us.